Hey guys, my name is Gareth and welcome back to my Finance Fitness YouTube channel where I break down personal finance, investments, stock markets, real estate. So if any of those topics interest you, make sure you subscribe to the channel. Investing in the stock market can be really daunting, especially if you're not a finance person. There are so many technical terms and things to wrap your head around. So in today's video, I want to look at the top 5 mistakes to avoid when investing in the stock market. Alright, so the first mistake to avoid is by not hitting the like button and turning it blue. When you hit the like button, it really helps the channel. So what is the stock market? Well, the stock market is just a financial market where people go to buy and sell shares of companies. These shares represent a piece of ownership of that company. So let's say you have one Apple stock. That means that you own a tiny fraction of the entire Apple business. People are much quicker to share their investment success stories than the mistakes that they've made in the past. And everybody makes investment mistakes, even the best of the best in the finance industry. And we can learn from the mistakes that we've made and also from the mistakes that others have made. I've made many of these mistakes and I want to share them with you so that you can learn from me bumping my head in the past. In the financial markets, you often hear the term buy low and sell high. And this makes sense to try and buy something at a low price and sell it at a high price in the future to maximize the profit that you make. But how do you know when to buy? Are the markets low now? How do I know when it's not going to go lower? Maybe you think markets are expensive now and you avoid investing because you don't want to buy high, yet it continues to go up and up and up. Since 2013, we've seen reports of how stock market prices are too high and overpriced after the market went up over 25% in that year. And at the time, the reasons given seemed quite plausible. Yet 7 years later, the stock markets have continued to increase. So even though prices were considered high at that point in time, if you had invested, you would have benefited from the increases over the last 7 years. And if you did not invest, you would have missed out on all of those investment returns. From 2013 till June this year, the S&P 500, which is one of the main stock market indexes, which tracks the overall market, has increased by more than 70%, even after factoring in the big drops we saw in March due to the global pandemic. Given the endless factors that can affect stock markets, even the best traders in the game get it wrong quite often, and trying to predict whether markets are going to go up or down can be really difficult, especially if you're an average investor. And so the chances of timing your investment on the best possible day is very low. I'm not saying it's impossible, but it is incredibly difficult. Ray Dalio is the founder of Bridgewater, and this is the biggest hedge fund in the world. He is often considered by many to be one of the greatest financial minds of our time. According to Ray, amateur investing is more difficult than the Olympics. There are more people competing, it's a zero-sum game, and yet many people believe that they can win. And history has shown us that only a small percentage of people end up making a lot of money, while many people lose money. Not only are you competing against people all around the world that do this on a full-time basis, you're also competing against high-frequency trading robots that can execute a trade in 1/64 millionth of a second. Ray wrote an excellent book called Principles, and it's a great read, so I have included a link in the description. So if you invested in the S&P 500 over a 15-year period ending in 2011, you would have received an average return of 7.8%. But if you tried to time the market and missed out on the top 10 days, over that 15-year period, your investment returns dropped from 7.8% to 4.1%. So just missing out on the top 10 days of a period stretching over 5,000 days has quite a big impact if you get the timing wrong. And if you missed out on the top 30 days or more, your investment return is actually negative 0.4% and you would have lost money. So let's make it practical and look at an example. So you invested $10,000 over that 15-year period. Then applying that 7.8% average return every year, your $10,000 would have grown to over $30,000. So you've effectively tripled your money over that 15-year period. Now compare that to the case where you tried to time the market and you missed out on the top 30 days and achieved a 0.4% negative return. In this case, your $10,000 over the 15-year period drops down to $9,400. And in this case, we're also ignoring extra transaction costs from higher trading as you're trying to time the market. And so with this example, we can really see the impact of potentially trying to time the market and getting it wrong, and why it's better to try and have your investment in the market for as much time as possible. So what can you do? Well, one of the most popular investment strategies is called dollar cost averaging. And here you're just consistently every month adding money to your investment instead of trying to time the market. I will cover some of these investment strategies in future videos. One of the things I found most difficult when I started investing in the stock market is keeping my emotions in check. If I saw the market was down for the day, I would feel some anxiety. Or if I saw the market was up, all of a sudden I feel great and like I'm some investment genius. I find myself checking the prices constantly to see if I'm up or down for the day, and this even affected the way I feel. And when it comes to investing in the stock market, letting your emotions overly influence your decision making leads to bad decisions, especially when the markets are falling. And this is one of the big reasons why many investors are not able to buy low and sell high, because as markets fall, they end up selling due to panic setting in. And panic selling is actually very common in the financial markets, and it really hurts investors, taking them years to recover those losses. On the one hand, maybe the falling prices in the stock market may be an exaggeration, and the best thing for you to do at that time is to sit tight. Sometimes the best investment strategy is to do nothing and wait for markets to normalize. On the other hand, maybe shares you hold in a company are falling due to a massive problem with the business, and it may be your best course of action to actually sell those shares and cut your losses. And this can be the other side of panic buying, where investors are too stubborn or overconfident to adjust their investment strategy on the face of some new negative information. This can be a red flag and indicate a fundamental shift of a company in a downward direction. Markets can be volatile and it's going to be a bumpy ride, so it's important that you keep your emotions in check and not let it influence your investment decisions. Instead, your investment decisions should be guided by logic, data and analysis as opposed to spur of the moment emotions. Enjoy the process of investing and building your wealth, but just be careful of letting emotions influence your decision making. And it gets easier with practice. During the sharp fall in the stock markets in March this year, where we saw a 30% decline in just 3 weeks, a younger Gareth would have maybe felt quite anxious. Seeing your portfolio drop by hundreds or maybe thousands of dollars in a day can be scary. But this time around, I saw it as an opportunity to pick up some well-priced stocks, and that's exactly what I did. Something else I found really useful to keep my emotions in check is to speak with other investors and get their impressions of my current understanding before I make investment decisions. Every investment carries risk, and the more risk you take on, the higher the return is that you expect to be compensated for taking that risk. So it's important that you're clear on what your risk appetite is and then formulate your investment strategy around that. Your risk appetite can be affected by many factors, including how old you are. If you're older, you may not want to risk losing money compared to somebody who's younger and eager to take on risk in the hopes of achieving high investment returns, knowing that they have a lot of time to recover any potential losses. How long you invest for. Maybe you know that you'll need the money in the short term, and because of that, your risk appetite will be lower. Your personality and how comfortable you are with potentially losing money also affects your risk appetite. Your risk appetite is a personal decision and one that needs to work for you. A common mistake I see is somebody who has a very low risk appetite and can't stand losing money goes out and invests in a risky stock that's very unpredictable, and this causes them a lot of stress. On the other side of the coin, I often see people invest in very conservative portfolios or leave their money in the bank, but then after time feeling very frustrated that their portfolios are not growing because they actually have a higher risk appetite and a more aggressive portfolios would have been better for them. Something I often see when helping people with finances and their investments is that partners have different risk appetites, and so it's important for them to have a conversation about this and make sure they're on the same page. Here you may want to consider taking a more balanced approach with some higher risk investments, some more conservative, and maybe some in between to make sure that both parties are comfortable with the investment strategy. FOMO, or fear of missing out, is a real thing, even in the investment world. Everybody wants to invest in the latest craze because they hope that all of the interest and hype around a company will turn into future profits. You hear others talking about the next big thing and you don't want to be left behind. Or many look at a broader industry at a macro level, but then don't go a layer deeper and look at the specific companies whose stock they're going to be buying. Maybe you think the airline industry is really cheap right now because many people are not traveling and you feel confident that travel will increase, so you go out and buy American Airlines. But maybe Southwest Airlines were in a better financial position and could have been a better investment. Or maybe investing in other parts of the industry like airplane manufacturers could be a better decision after looking at their strengths, weaknesses and strategic positioning. If you're investing your hard-earned money into the stocks of a company, make sure you understand that business as well as possible and have enough comfort that they will continue to thrive going forward. And if you're not confident in doing all of this analysis, then maybe a more passive strategy is a better option for you, like investing in ETFs or exchange traded funds. These are low-cost funds that give you exposure to the broader market, and I'll be doing some future videos on these, so keep an eye out for those. Stock markets can be really confusing. There are thousands of companies and trying to figure out which one is right for you to invest in can be extremely overwhelming. So trying to do it alone can be really intimidating and lead to some big investment mistakes. So here it may be good to speak to a financial advisor or a finance consultant so that they can help demystify some of this for you and help you with your investment journey. Financial advisors typically charge a percentage of the investment that you make with them, whereas a finance consultant will generally charge an hourly fee. They will also help you consider important things like taxes. For example, many countries have tax breaks. If you hold an investment for a certain period of time, it could be classified as capital gains tax, and this has a lower tax rate than your normal tax rate. Another option is to join investment meetups in your area and brainstorm ideas with other people that are interested in investing in the stock market as well. This is something I did when I started investing in stock markets. I connected with some friends that were also interested in investing in stock markets and would have a catch up every few months and share ideas. Everyone came with the mindset of contributing insights and would do research leading up to the next meetings. And so these investment meetups became really interesting and we had great conversations. And I'm even involved in many of them to this day. Don't be afraid to ask questions and ask for help and guidance, because the price you pay for not doing so could be really high. Also, as we're building this finance fitness community, share your thoughts in the comments section and use the community as a sounding board so we can exchange ideas and stimulate thought. On that note, in the comments section, I would love to know which of these mistakes have you seen in the past, or what stock market investments are you looking at the moment. So that's it for the video today, guys. Thanks so much for watching. If you enjoyed the video, make sure you give it a thumbs up and share it with others. I'll see you next week.